In this final section, we bring it all together to talk about how our approach leads to the potential for strong returns for our shareholders. You'll hear again from Sebastien, but also from Joanna, who recently joined our team as CFO. Prior to Endeavour, Joanna was our audit partner, which allowed her to build a good understanding for our business. Sebastien, back to you.
To deliver on our purpose and realize our potential for our shareholders, we need to have a resilient business and one that is a trusted partner to our stakeholders. I think that we have earned that trusted partner status with host governments and communities where we operate. That secures our social license. This, combined with a high-quality asset base, provides Endeavour with a strong foundation to reward shareholders. That reward is offered by improving our per-share metrics, represented by metrics such as net asset value per share, increasing dividends per share, and cash flow and earnings per share. Growth in these metrics are supported both by a resilient business and ability to continue to repurchase our own shares when appropriate. Rewarding shareholders also means ensuring that all of our projects compete for capital on a risk-adjusted returns basis to optimize the value that we are able to generate. You can now see how our approach to capital allocation has evolved over time. In the initial phase, we sought to improve our portfolio and focus on growth. We are now in a position where we have a leading cash-generative asset base combined with a solid balance sheet. This means we can now deliver on our next phase of organic growth and provide returns for shareholders. So we're well positioned to meet all of our corporate goals on a sustained basis, making the necessary investments in our operations, providing economic benefits to our host countries, and establishing an attractive shareholder returns profile. From the portfolio's successful transformation, we now have a robust portfolio that is capable of delivering strong returns over the long term. At the front end of the project pipeline is exploration, where we have consistently added ounces and target a discovery cost of less than $20 per ounce. Our project pipeline is competitive across the industry, and our management team has a strong track record of delivering projects on time and on budget. Using discipline and effective screening metrics, we ensure that our pipelines contain the best projects capable of delivering returns through gold price cycles. For Endeavour, we instilled that discipline by applying a 20% after-tax IRR hurdle at gold prices of $1,300 per ounce. With that rigor applied, we are able to benchmark projects against our 20% ROCE target with conviction. They either compete and are feasible, or the capital will be returned to our shareholders. These criteria link back to our core project criteria, which we spoke about earlier, and you'll probably hear again. We are focused on advancing a portfolio of assets with a 10+ year mine life, the capability to produce more than 200,000 ounces per year, and an all-in sustaining cost of below $900 per ounce over the mine life. Applying that disciplined approach sees our legacy assets having gone through a core investment phase well positioned to generate attractive returns. We measure this through return on capital employed. In 2020, this more than doubled compared to the prior year to 20%. Consistent with our capital allocation benchmarking, we intend to maintain our focus on this important metric to test future investment. Our approach to advancing quality near-term growth is exemplified by the 3 projects highlighted on this slide. First, and probably most significant from a value perspective, the expansion of the Sabodala-Massawa operation. Phase 1 of the expansion project is underway today and will add approximately 90,000 ounces per year of gold production capability for a very modest capex of $20 million in 2021. Following this optimization, the Phase 2 expansion will consider a refractory gold processing circuit. A definitive feasibility study on this project is targeted for completion during Q4 2021. These initiatives are set to position Sabodala-Massawa as a Tier 1, low-cost, long-life asset. On the right side of the page, you can see our two most advanced greenfield projects, Fetekro and Kalana. We recently completed positive pre-feasibility studies on these assets, and they are now progressing through definitive feasibility studies targeted for completion in late 2021 and early 2022 respectively. Both projects offer compelling returns and are viable. However, we want to ensure we are optimizing our development plans to ensure the best DFS results before making a construction decision. As a result of our focus on high-quality assets, our portfolio has evolved systematically, with declining assets replaced by newer mines with growth upside that achieve our stated objectives. Looking forward, we have a diversified portfolio with embedded organic growth options and the ability to produce more than 1.5 million ounces annually on a sustained basis, and at an all-in sustaining cost well below our targeted $900 per ounce. This profile incorporates the Sabodala Phase 2 expansion based on the PFS work that Teranga completed and assume a start in 2023 and a ramp-up in 2024. We are, however, expecting to improve the results, which could further boost production. It also includes the development of our next growth project, with first production commencing in late 2023. We've assumed that Karma ceases production in 2022 and have not factored in any material additions in exploration nor any potential to debottleneck some of our existing plants. Given the conservative assumptions incorporated into this outlook, we believe that we will be very well positioned to, at a minimum, deliver this production growth. This in turn demonstrates strong cash flow generation capabilities and underpins our ability to reward shareholders over the long term. I will now invite Joanna to walk you through our balance sheet strengths.
Thanks, Seb. I joined in late 2020 and am fortunate to be joining at a time where the company is in cash harvest mode. The chart of net debt tells the Endeavour story well. The company finished its build phase in mid-2019, following the investment of more than $1 billion in the construction of both Ity and Houndé and funding our exploration programs. With the completion of Ity in 2019, we have now been able to significantly deleverage ourselves, finishing 2020 in a net cash position for the first time. Having assumed the debt held in Teranga as part of the acquisition in Q1 of this year, we are again in a net debt position at March 31st. But we continue to have a robust balance sheet, with strong cash generation anticipated to continue in the next few quarters, in particular with the continued strong gold prices. Our balance sheet enhances Endeavour's resilience. It allows us to navigate more challenging gold price environments and continue to meet all of our shareholder and broader stakeholder obligations. This includes paying a sustainable dividend, funding organic growth internally, and ensuring we can return excess capital to our various stakeholders. Given the strong gold price environment and our diverse portfolio, we are currently generating levels of cash flow that will enable us to meet our objective of a net cash position of $250 million in the near term. With the recent acquisitions of Teranga and Semafo and the resulting increase in our operations, we have continued to manage our working capital and our overall balance sheet to ensure financial flexibility moving forward. The extension of our revolving credit facility and obtaining the bridge facility enabled us to reduce the cost of group debt upon assumption of the Teranga debt in February. In the past 12 months, the excess cash generated from our operations has been used to repay outstanding leases and other long-term liabilities, as well as repaying the RCF. Our bumper liquidity available at the end of Q1 was largely the result of the La Mancha $200 million private placement falling at the end of the quarter. Going forward, we will continue to focus on gross debt reduction while maintaining the financial flexibility to assess our various growth opportunities for the lowest cost of capital. Our current debt structure is a diverse set of lower cost debt instruments, and we will continue to manage our liquidity and overall debt structure well in advance of their maturity in the first quarter of 2023. While we are expected to reach a net cash position in the near term, if we take a more holistic view, we do believe that our business can support debt and should do so at opportune times. This allows us to make efficient use of financial leverage to maximize returns to shareholders. To remain resilient across the gold cycle, Our goal is to target a maximum leverage ratio of 0.5 times net debt to EBITDA. This will allow us the financial flexibility to periodically increase debt levels to deliver any major organic growth initiatives, with the goal of rapidly deleveraging following the capital spend. We also believe that we have a robust balance sheet relative to our peers. We focused on building assets with strong financial returns, and this is the prime catalyst to our ability to deleverage quickly once they enter production. Looking across the sector, we are very well positioned with low leverage compared with our peers. This now positions us very strongly in terms of supporting internal investment and delivering shareholder returns. Seb?
Thank you, Joanna. As I've mentioned, a key part of Endeavour's proposition, in addition to production growth and ability to discover gold at a very competitive cost, is our sustainable shareholder returns program. I want to go into this now in a little more detail about what it means in practice. Given the confidence we have in our business and to provide visibility to our shareholders, we've decided to implement a minimum progressive dividend policy. We're targeting a distribution of at least $500 million over the next 3 years if gold remains above $1,500. This is aligned to our expected production growth, so we are rewarding shareholders with a growing dividend, both in nominal terms and of course on a per share basis. Our first dividend saw us pay 37 cents per share, or $60 million, earlier this year. For 2021, we expect the minimum to be more than doubled on a nominal basis, which translates into at least 50 cents per share based on our current shares outstanding. We will announce our H1 21 dividend along with our Q2 results. In addition, we'll continue to seek further opportunities to provide value to shareholders based on the continued strength of our balance sheet, which at the moment is benefiting from the higher gold price environment. As long as our leverage is below 0.5 times, we can maintain the resilience in the business while having the potential to provide supplemental returns in the form of higher dividends and buybacks. Given where we are today, we are already delivering these. We launched our share buyback program in April, which provides for up to $250 million over the next 12 months. In the first 2 months, we've already bought back $50 million worth. Here you can see how cash returns compare to our peers in the sector. With our proposed minimum dividend for 2021, as well as the buybacks already complete, it currently represents an approximate yield of 3%. The important thing to remember is that with our balance sheet, along with our cash flow generation, this does not stop us from pursuing the growth options I laid out earlier. Nor is it dependent on market conditions. It's sustainable throughout the cycle. In summary, this slide illustrates well our roadmap for rewarding shareholders across cycles. Ultimately, it's a dual approach of maintaining a resilient business and having a disciplined capital allocation model. As mentioned earlier, we have a high-quality portfolio and our business is well positioned to remain resilient over the long term given the unmatched competitive advantage we now have in West Africa. Our balance sheet strength is also a key component of maintaining our resilience, and this of course is achieved through our disciplined approach to capital allocation. And finally, to reward shareholders, we focus on both share price appreciation and delivering on our shareholder returns program. To drive value and gains within our share price, we focus on unlocking value within our business. Put simply, this means increasing our underlying net asset value per share and free cash flow. This can be achieved by further optimizing our assets, extending our mine lives through brownfield exploration, generating new projects organically through greenfield exploration, and by expanding our building new mines. Of course, all of this is only possible thanks to the strong operating, exploration and projects teams we have. In addition, I do believe that obtaining our UK listing will help unlock further value for shareholders by increasing the appeal and demand for our shares. With the removal of Randgold, the LSE has relatively limited option for investors seeking significant diversified gold production exposure. Upon completion of the listing process, we will be the largest premium London-listed pure gold producer, and we also believe we will be well positioned for inclusion in the FTSE. Our shareholder returns program is also very competitive, with the promise of a minimum progressive dividend supplemented with the ability to pay additional dividends and to implement buybacks. For all these reasons, we believe Endeavour is ultimately positioned for generating strong shareholder returns over the long term.
Now that you've heard from management, I hope that we have lived up to the promise that I set out at the beginning of the event. As you can see, a great deal of hard work has been done over recent years to reshape our business into one that appeals to a diverse investor universe. When we set out 5 years ago, our first priority was to appeal to precious metal funds. Given the significant change in our top 20 register, which is now mainly comprised of blue chip investors, we have achieved that goal. Most importantly, most are overweight Endeavour due to their strong conviction in our ability to deliver immediate cash flows through production, short-term growth through project development, and long-term growth through exploration. With the improvement in our portfolio and our larger market cap following the recent acquisitions, we now have an attractive business and the enhanced capital markets profile required to attract large generalist funds. We are now able to appeal to a wide range of investment strategies. For those who are deep value driven, the key feature for you might be our attractive valuation and our ability to remain cheap based on discovering more ounces. For those of you that are more growth oriented, you might appreciate the optionality of our industry-leading project pipeline, which of course is underpinned by our company's ability to meet our 20% return on capital employed metric. Given our recent dividend initiation, we are now also starting to attract dividend funds, and I'm sure that a minimum progressive dividend with the potential for it to be supplemented with more dividends and buybacks will be appealing to you. Our leadership in ESG is also opening us up to a class of ESG-driven investment funds. Shareholders that have visited our sites have seen firsthand the positive impact of our operations. For this reason, we believe that $1 invested in Endeavour can go a longer way than that same dollar invested elsewhere. I'm also seeing more and more demand from emerging market funds, due both to the strong growth that West Africa has seen across other sectors and of course its rapid growth in the gold mining sector. If you are a family office, you will also take comfort in knowing that your investment is in good hands, given that you have a like-minded investor such as La Mancha, another family office, as a cornerstone shareholder. The last two groups are the ones I spend the most time worrying about. These two classes have grown in importance given their size and market influence. Regarding indexes, we expect to be included into both the FTSE and MSCI indexes, which will be a strong catalyst for our shares. Regarding quant funds, given our sustained upward trend in per-share metrics and our track record of delivering on guidance, I hope that this will work well within your secret algorithm. So, after having heard all of this, if you are sitting within the fund and think that we might be a good fit for a colleague running a different strategy, please do refer us.